you're in person or virtual tonight. Elderwerks is a non-for-profit 501c3 organization who focuses on all aspects of aging well and helping older adults. From healthcare resources to senior housing resources to additional educational resources, advocacy, help with planning with financial planners and lawyers and different things like that. We are so honored to have the founder and president of Brant Financial with us tonight. I'm going to introduce her. Brant Financial actually isn't too far from the center here in Palatine, and they are celebrating their 40th year in business and providing guidance for seniors. When you see Carol come on the screen in just a little bit, don't be afraid. It's not a real elephant behind her. Her name's Sophie, and Carol will talk about her, but you're going to see her on the screen in just a minute. Carol is a certified long-term care professional and is active and involved in many different aspects of the community. She is a member of MIT, Planning for Longevity Network as a contributor and collaborator on topics concerning brain health, aging, and longevity with a focus on living better as we age. Carol has worked with us here at Elderwerks, helping educate clients for many years. And with her long-term care planning table talk series she has become one of our professional partners as well and helps sponsor our Aging Better Expo. Last year, she was our very first diamond sponsor, and she is sponsoring it again this year. Our Aging Better Expo is in Hoffman Estates at Stonegate Banquet and Conference Center on August 14th. Be sure to write that down and save the date with us. She will be there and be able to answer any questions in person as well. Along with Carol tonight, here in the Elderworks Center, we have Jim Brant, Carol's husband and business partner, plus Michelle and Katya, who are also two of the amazing team at Brant Financial. We do have two volunteers in person as well that Brant Financial brought with Marcia and Jill. So big welcome to all. And so Carol, I understand there's an elephant in the room. We could use your expertise in talking about it and understanding our options so that we can plan for the future as we age. Carol and Sophie, take it away.
Thank you. First, I want to say thank you for that introduction, but I also want to take a moment to say that Elderworks doesn't nearly brag enough about themselves. I am calling upon them every week. They have helped so many of my clients, friends, and community people. It's just an amazing resource. In addition to that, I don't know if I hope you've all gotten this, but they publish this huge directory of resources every year and give it out free. I've had people tell me they'd pay $50 for this thing, and it's just an amazing place to find resources, professionals of all types. But there's really no other organization like it. They have vetted so many home care agencies, nursing homes, assisted living facilities, and if something happens, somebody has a stroke, accident, you need help. Like, what does a person do? Just go to the yellow pages or ask one or two people? No, you can call Elderworks. So think of them through all the stages of your lives that are coming down the road, because they have resources for just about everything. But with that, yes, there is an elephant in the room, but today it's to talk about addressing the elephant in the room and not having it be so scary. So let's begin. And you're going to help me go to my first slide. Yeah. No. Okay. Great. Okay. So we're going to talk about aging well, living well, and planning well. We're going to talk a little bit about what long-term care is and who pays for it, because that's a big question people have. And that's part of where some of the scary part comes into play. And we're going to talk about plan types and cost examples. because I think sometimes people hesitate because they think it's just out of the world. And we sit down with people and they say that I had no idea. I should have done this before. It's not that bad. So there's just many ways to solve the problem. I'm having a little difficulties going to the next screen here. Let's see.
There we go. Now it should be
Okay,
working.
okay. All right. The elephant in the middle there, that's our plans for long-term care, but the feelings that are out there are everything from fear, procrastination. Sometimes we feel awkward. Sometimes we're confused. Sometimes we're embarrassed to talk about it in a crowd because there's various different thoughts on what exactly long-term care is, and we're going to talk about that. So people avoid, they're reluctant, and then some are in plain denial. I've had people tell me that they just go up to their room and not eat anymore if something happened to them and they got a bad diagnosis. So that's not the way we want to live. There's ways to take care of ourselves. So first we're going to have just a little bit of talk about lifespan versus health span. It's one thing to live a long time, but what about our health span? That's that period of time that's spent in good health and free from chronic illness. And we have to work at that to stay away, keep away the disabilities of aging. So our lifespan, we could easily end up living well over 100, but if 50 of those years are spent in poor health and affected by chronic illness, we might need to have a plan in place before, not waiting until that crisis occurs. So some people say, and I tend to agree, that health span is almost more important than lifespan. We'd like to live a long life and feel good while we're doing it. So something to think about. What are the odds, though? I'm getting the word to talk a little louder, and I can do that. Okay, what are the odds? Let's take a look. The odds of a home burning down, 3 in 100. That doesn't happen too often, but there you go. Our chances of totaling a car at some point in our lives is 18 out of 100. On average, 72 of 100 people will end up needing some type of care after age 65. We see those statistics all the time. You've seen them in AARP magazine. You see them in any advertisement for long-term care. But with these odds out there the way they are, less than 7% of adults over 50 have actually done anything for extended care. So we're going to talk about aging well, living well, planning well, because my idea is not to need any of these policies or plans or to need a caregiver at home or in a facility. How can we do that? Well, one of the things we can do for aging well, and this was something that we did at the Expo, is I had a ukulele player, singer, songwriter there with me, and we talked about singing, and we'll talk about that, stretching and strengthening. Why sing? A quick hello, you've heard people talk. A quick hello is all it on how old someone might be. Men's voices go higher as they age, and women's voices go lower. So singing can impact immunity, lung function, memory, mental health, coping with physical and emotional pain. And there's so many places to sing: in the shower, in the car, in your house. Singing daily, it can benefit our health, and our hello can sound like it always has done. And just like any other exercise, just because your voice might sound a little scratchy now, it doesn't mean it has to stay that way. You can exercise improvement, and I believe that about the voice as well. Stretching. I stretch every morning, and I think stretching is so important. Maintaining mobility, it can be difficult without stretching. It's just tough. If you end up not doing it for a couple of weeks and you've been stretching, you can feel it when you get up from the table or chair or get out of bed. But our muscles and joints can weaken. You know that if you've spent any time in the hospital or had anyone you care about spend time in a hospital, they've probably talked about how tough it was when they started to move again. But you want to stretch for flexibility, increase your circulation, blood flow. There's all kinds of health conditions that are improved by stretching. It produces greater quality of life as we're aging, and helps with back pain, arthritis, falling. If you stretch and strengthen and you have stability, you can help yourself keep from falling, slip on the ice and be able to catch yourself. But I do truly, it's been about 7 years now. I stretch in my bedroom first thing, and I spend about 15 minutes at it, and I do every kind of stretch you can think of. And yes, it wakes him up a little bit. While I'm doing my son says, you mean she's doing her calisthenics there while you're still sleeping? Like, yes, that's true. but I get it done and I get it out of the way, and I feel so much better for doing it. And so I want to just plant a little seed here, because maybe you can pick up a little inspiration tonight, and some of these things you can take home with you and call them takeaways, and just think about stretching. Spend 10 minutes stretching in the morning. Why strengthen? Same thing. It enhances our quality of life. It improves our ability to do everyday activities, builds muscle, protects us from injuries. It contributes to better balance, which reduces falls. You can stand, if you're in line with a shopping cart, stand on one leg, hold on to the shopping cart with your finger and balance yourself. You can do it while you're in the shower. I work on balance while I'm blow drying my hair in the morning. You can be anywhere, and you can have 10, 15 minutes of balance practice out of the way just from your everyday activities. I saw a woman standing outside of, I think it was a medical office or something. She was waiting for her appointment or waiting for a person, standing outside reading a book, standing on one leg. Like, heck, I could do that. I can actually stand on one leg all day long, but when I'm in the yoga class, then I don't have my balance anymore because people are looking at me. But no excuses. You could be brushing your teeth. Well, that's another thing. 3 minutes. You can stand in balance while this is a little timer for, no, this is 2 minutes. 2 minutes, 2-minute timer for brushing your teeth. Alternate back leg kicks or balance while you're brushing your teeth. And there's 2 minutes of a really good habit out of the way. So no excuses while brushing your teeth, shopping, waiting in line, cooking, watching TV, watch a TV show. You can stretch or balance. Just find little pockets to put these things in. The busiest people can do that. And I'm pretty busy, and I find my space. Living well. Okay, I think these things are really important. Keep the bad guys out while at home or away. Have a home security system. I remember this many years ago. My father-in-law said Jim's mom had passed away and he was living alone. He was a big guy. Jim is 6'5". His dad was a big guy. And he said, I can't tell you how comforting it is to come home and know that there's no one in my house. Bam. I never thought about that. Home security system came very shortly after that. Add home safety features. Like in the shower, simple grab bars in the shower. If you live alone, or even if you're not alone, you're not always with someone when you're taking a shower, and there's not always someone home, but there's so many falls and injuries that take place in the bathroom. It's kind of a dangerous place because it can be slippery. And if you have a surgery, then you're even more at risk. But not handicapping, but grab bars in the bathroom can be a good start. And then connect with help with some sort of life alert system or smartwatch. I don't care if I was 30 years old and I lived alone. I think I would have some sort of device in the house where I could call for help. Want to have something if I fell down the basement stairs, or if I had a occurrence. My mom slipped in the bathroom many years ago, broke her nose, knocked herself out. Fortunately, people were home, but stuff happens. So I just think that's a good idea. And I think these simple little things can give us peace of mind. Take a breath, and little stretching things and little safety things don't cost a lot of money and don't take a lot of time. Planning well. I'm going to take a quick pause to bring a little more clarity to understanding long-term care, and then we're going to talk about it some more. Yes.
Understanding long-term care. You are about to learn the 3 most important things to understand about long-term care. First, what is long-term care? Second, where do you receive long-term care? Third, the hidden significance of long-term care on the people you love, the people you've invited into your life. What is long-term care? Long-term care is care that is needed over an extended period and comes in 3 types. One type of long-term care is personal care, sometimes called custodial care. It's when you may need help with various tasks we do each day, but take for granted when we were healthy, such as eating, getting dressed, or walking. The second type of long-term care is skilled care, for which you need a skilled specialist or nurse. The third type of long-term care is supervisory care, if you get Alzheimer's or other kinds of dementia. Where do you receive long-term care? Long-term care often evokes images of a nursing home, and while that is a subset of care, most people prefer to stay at home or receive care in an assisted living facility where they can be with other people. The hidden significance of long-term care on the people you love. It's of critical importance to understand what long-term care does not just to you, but to loved ones, both emotionally and financially. Long-term care causes you to be unable to fully care for yourself, and it impacts those you love by requiring their full attention. Will it be from your husband or wife? One of your adult daughters or sons? What impact will that have on them? You may say, I would never ask those I love to care for me. None of us want that. But if we fail to adequately plan, what choice are we leaving them? Of course, they will want to help as best as they can. Proper planning can help you afford and access the care you need so that your family can stay focused on caring about you and not for you. That planning often includes the right insurance to directly help you and also help the people you've invited into your life. Now that you know the 3 most important things about long-term care, it's time to have an insurance specialist help you be better prepared for long-term care. Understanding long-term care. You are about to
So this was covered in the video, but let's talk about it again a little bit. Exactly what is long-term care? I was asked to cover that by Elderwerks because surprisingly, you would think that everyone knows what that means, but I thought they did, but apparently that's not quite the case. Some confuse it with healthcare. When you talk about long-term care, they think we're talking about health insurance or healthcare provided by skilled medical personnel. Other people think that we're talking about medical insurance when we talk about long-term care, but some people think it refers to being in a nursing home, but actually long-term care is not necessarily a policy, a medical plan or a place, but it's that personal care or supervision that we might need at any age for an extended period of time. And you'll see reference to extended / long-term care throughout the talk here. But this type of care is generally associated with aging, but honestly, it can happen to anyone at any time. We had a neighbor that was disabled at 18 and paralyzed the rest of his life. Car accidents, early illnesses, MS, things like that can disable someone at any age. And of course, due to accident or illness at any time. So when we talk about risk management and long-term care, we insure everything else in our lives. We buy health insurance to protect our wellness, and we have auto insurance to protect our cars and transportation and liability. We have life and disability insurance, and we have our homeowners insurance. We wouldn't think of going out of town or leaving our home, our bank wouldn't like it either, would they? Without having homeowners insurance, but somehow the long-term care insurance and the plan, the covering our retirement, which is basically what it is, because if we need care and have not set a plan up, we're basically tapping into our retirement assets. So why is that? Why is the question mark there? And why is it on the back burner? Well, it's mostly because those other insurances seem to be required by our lenders, by our bankers, and many times the life and disability insurance comes with our employer-sponsored plans. Homeowners, like I said, required by the lender, but the long-term care is not a requirement. So we end up worrying about our mortgages and college education and trying to build a nest egg and max out our 401k before we think about long-term care. So that's why it ends up last. But congratulations for you all being here today to talk about the elephant in the room and learn more about it, to see if having a plan in place works into your lives. Did you know Illinois is a partnership state, and this is important for certain types of plans. It goes back to August 2007. Illinois expanded the Medicaid program to allow for Illinois to be a partnership state, and it has to do with policies purchased after the effective date, providing guaranteed Medicaid asset protection. I am not a Medicaid attorney. I try to stay in my lane. I will refer you. Elderwerks will refer you because they have some super elder law Medicaid specialists to speak about this in detail. But in a nutshell, if you buy a partnership qualified long-term care plan in Illinois and 48 other states and use it and use up the benefits in the policy, instead of having to spend down to $2,000 and be broke before Medicaid kicks in, you are able to keep that amount that was in that policy on your side of the board for your family. So it disregards that amount of assets. So partnership assets are also not subject to Illinois Estates Recovery Program at death, so they won't go back and get it from your family because money was spent on you in a Medicaid facility. So basically, I've been told this. This may or may not be true with all facilities, but if you have a plan in place, even a small plan, first of all, you've got the partnership protecting you, but you can get into a place that maybe you chose, not a Medicaid facility, a place that you choose, an assisted living facility or a nursing home, if you must, that you choose. Speak up. I need to speak up. Okay, we'll do that. So with having a plan in place, the facility knows that you have some assets. And so therefore, when your assets run out, you're not sitting there trying to get into a Medicaid only facility. So some people tell me that having even a small plan, even 2, 3, or 4 years of coverage that pays for your care can be a big help when you have to then go and tap into Medicaid. You've got the facility helping you, knowing that you've got that plan in place. They know how many years of coverage you have, and they have received those funds directly and then help you accordingly. So the partnership, it says here, the partnership is between the consumer and the Illinois Medicaid program and a private insurance company. All of the plans are not partnership qualified. Some of the life insurance plans with riders on them are fantastic plans, but they're not considered Illinois partnership qualified. The qualified plans tend to be the true traditional long-term care plans. However, some of the hybrid plans have come out where they've actually the carriers have broken out. This piece is not partnership qualified, but this amount of money is. So that's all made clear when you're looking at these things. But many of the policies can give us that break. Who pays for care? This slide is small and I won't read it all to you, but basically it goes across the top addressing Medicare, private Medicare supplements, Medicaid, and paying on your own. And on the left is the component. So nursing home care, without getting into a long discussion on that, the first 100 days of needing skilled care, and you've maybe learned about this when you bought your Medicare supplements, can be paid by Medicare in your supplement. You heard me say the word skilled care in there. Skilled care is needing rehab, maybe coming out after a knee surgery, hip replacement, something like that, needing skilled care and rehab, maybe needing wound care and medications that can only be delivered by a skilled professional. So that first 100 days is okay, but after that, you can see across the board, does not pay, does not pay, does not pay. Medicare does not pay for assisted living. Private Medicare supplements do not pay for assisted living, long-term care facilities, care at home. There's some care, home care available under Medicare, but it is limited. But think mostly that first 20 days is kind of a slam dunk. After that, you need to be in need of skilled care, not just someone to help you with the activities of daily living. And we'll talk more about that. But we're pretty much on our own. So I have to say that about half of the people that come in for the When I'm 64 talk, I help people older than 64 with Medicare supplement planning. But when people come into the first time, I have to say about half of them believe that Medicare covers long-term care expenses and are very surprised. And there they are. That's what they look like. So the thoughts are, doesn't medical insurance and Medicare pay? No. Personal medical insurance, group medical coverage, unless you have a group long-term care plan, Medicare and Medicare supplements never pay for long-term care. Medicare Advantage plans don't pay either. Plans pay for short-term care up to 100 days maximum, but again, only if skilled care and rehab is needed. Medicare never pays for long-term care. So keep that in mind when you think about the future. As we age, we just might need some help. So we're going to take a look at the different kinds of plans here quickly. First one is going to be traditional long-term care. You heard me say this a moment ago. Traditional long-term care is the kind of plan that does qualify. It does. Yeah, that's a positive. Does qualify for the Illinois partnership. So basically, first people tend to reach out to family members and hope to be cared for at home. We want to stay in our homes as long as possible. And if we're at home, a long-term care plan can provide the benefits to keep us there. It can bring in the equipment and personnel and bring in the services that we need. What happens when the services and the personnel and the procedures exceed that which can be done at home? Then everybody gets together and talks about, gee, we need to go somewhere else. And maybe that's in a care facility. When that additional care is needed that can't be delivered at home. When that occurs, a long-term care policy also pays for assisted living, nursing home, dementia care, and all types of facilities, adult daycare, hospice, all of that. Traditional long-term care policies, chronic illness policies, and long-term care riders, they all have a common thread. To become eligible for benefits, they all require, and these are the characteristics that made these plans TQ, meaning tax qualified, so that the benefits are tax-free, and that's a big deal. So we're eligible for benefits from our policy, a rider, chronic illness plan, all of the different plans out there that are deemed long-term care like, when we need assistance in the what's called activities of daily living. At least 2 of them, if we need help, 2 of the 6, then we're qualified for benefits. And those ADLs, activities of daily living, are known to people in the medical world, but many times sitting down like this as we're hearing about them for the first time, but it's transferring, going to the restroom, continence, bathing, dressing, and eating. And if you think about it, most of these things we need to, most of these things we need to deal with before we even leave the bedroom. We need to be able to get out of bed and transfer from the bed to a chair, or, get to the restroom, be able to get to the bathroom, take a shower. Hopefully we've been continent through the night, dress ourselves, and only then, the last one, moving out of the master bedroom to the kitchen and prepare ourselves some food and be able to eat it. So if we need assistance in 2 of 6 of these activities of daily living for at least 90 days, we are eligible to receive policy benefits from traditional policies, riders, hybrids, all the time. So after that period of time, in general, once we become eligible, the policy benefits, the elimination period that's kind of like a deductible, right? 90 days, 90-day wait before benefits begin. That's kind of a deductible. Then the benefits begin. The elimination period, by the way, starts on the first day we're deemed chronically ill and start receiving benefits. And different policies have a little bit different guidelines there. So I'm kind of talking to you about this in a broad stroke here. But once that elimination period has been satisfied, and some of the plans do pay immediate cash benefits. Some do pay without a waiting period, a little bit upfront. So we can talk about that too. But then benefits for the covered services, depending upon the plan, are either paid to us or the facility, each and every month. And it's as long as the policy benefits last. If we have a lifetime plan, then it's going to pay for life, XYZ dollars for life. If we have a 2-year or a 4-year or 5-year plan, it's going to pay that length of time. If we're dealing with a pot of money, and I think of these plans as you're trying to gather a pool of money so that when you need this assistance, you've got this pool of money to draw on. As long as that pool of money lasts, that's how long we'll be able to be cared for with those dollars. So as long as we remain eligible, benefits for covered services would be paid until that money's gone. So we're going to take a look at what a traditional long-term care plan might look like, and we're going to see some various examples and ages. These are all examples, but they are all examples of actual people that did enroll in these plans. Their ages are exact. If you apply for something and it's a different plan and you're a different age, it's going to look different, but this is going to give you an idea. So this is a traditional long-term care insurance policy, and it might look something like this. In order for them to be partnership qualified, they have to have a rider on them for inflation. They can't just be, oh, I bought $100 plan, now I'm all set. It has to have an inflation rider on it. So this particular one has a 3% lifetime compound inflation rider and provides an immediate monthly benefit for Larry, who was 65 when he bought his plan. Well, he didn't do it when he was 64. He wished he did, but he waited another year. But it started out with $6,000 a month for 5 years. So 12 times 6, that's $72,000 tax-free for his care. It assumes a 5% discount living with a partner. And there's other discounts that can be available too. You see there, it's noted that it's partnership qualified. The premium is $318 a month. Most people think that it would be a lot more, but it's top-notch plan. 5-year benefit. Some people say, gee, is 5 years enough? The average stay in a nursing home for men is 2 years, women is 3 years. So people can need care longer at home. There are people that have been disabled in their 40s and been disabled for life. So I'm not discounting that, but doing something could be important. So for $318 a month, he gets a long-term care plan. He starts out with $360,000 pool of money, which is going to spin off $6,000 a month tax-free for care. What if he only used $3,000 a month? Then it would last twice as long, right? It would last longer because he didn't use it all. With that inflation rider, now this is guaranteed. This is not an investment. This is not what if, this is not maybe. The inflation rider is guaranteed. The benefit is guaranteed. It will increase that pool of benefits by year 15 to $560,000, which will spin off $9,300 a month. It will guaranteed grow to $650,000. It's at 3% compound inflation, growing to $650,000 and $10,800 a month at year 20. And in 30 years, he will have $874,000 or $14,600 to tap on. He'd be 95. But between 85 and 95 is when we might need to tap on these. So there's plenty of time to cook it. Why did he only start out with a $6,000 plan? It's kind of like funding college. When the baby's just a year old, we don't need to put the full college tuition away because we can invest that money and grow it. Well, this is kind of that concept, except we're not investing it. It's being put aside with that inflation rider to have it grow. So should he have that $874,000 pool of money and then plow through that, he will be able to keep $874,000 of personal assets on his side of the board if he and his wife have that in their personal savings. They do not have to go broke and spend that down and set up a trust or a Medicaid annuity where you give it away practically and just live off of it, just get to use the income. So there's lots of reasons to do that, and that's not a god awful monthly premium. The next one, Hank. Now, Hank waited till he was 75. What is a 75-year-old person going to get? Well, his traditional long-term care plan might look something like this. He took a plan with a 20-year 3% compound inflation protection rider. So it's going to increase every year at 3% for 20 years and then stay level. That helped adjust the premium to his budget. He took a $3,000 a month benefit for 4 years. And a 5% discount living with a partner. So there's Hank 75. This is Illinois Partnership qualified. This is just like the plan in the prior slide, but different guy, different benefit, different age. He needed to be around $375 a month, and we got him in at $373. So he gets a long-term care plan where the initial pool is $144,000, but immediate $3,000 a month tax-free. That inflation rider is going to increase to $193,000 and $4,000. In 15 years, it's up to $224,000 and $47,000, and in 20 years, $260,000 and $5,400. So he has a plan. He has done something so that he can get into a nice place of his choosing and not just directly wait and go into a Medicaid facility. And this is not a Medicaid discussion, so it's not my area of expertise to talk about Medicaid facilities. Elderworks sure can, and the elder law attorneys can talk more about the transition there. But again, not an awful premium. A traditional long-term care plan can also be set up for married and unmarried partners. And this is the situation with Philip and Jeremy, 52 and 56. Philip at 52, his premium was $256, and Jeremy $276. Each of them, they're separate. They went in together for the discounts, but they each have their own pool of money. They each have started out with $360,000 of benefits, $6,000 a month. Again, is $6,000 enough? Yes. And in 50s, starting out with a $6,000 a month plan that's going to increase at 3% inflation. That's a great number. I was actually suggesting they could go a little bit lower, but they both agreed they wanted to start with $6,000. That inflation rider is going to increase each pool. So they're going to have they have a 3% compound lifetime rider on theirs. So the benefit starts at $6,000 for 5 years. They got a 15% partner discount and a 5% wellness discount. And what their numbers look like, each of them in year 15, that pool of money that started out at $360 is up to $560,000, over $9,000 a month. Then it grows to $650 in year 20 at $10,800. And in year 30, $874,000, $14,600 per month coming in. Will it pay for everything everywhere in the, all the time? No, but it's a good chunk. That long-term care planning doesn't mean I have to go out and buy a policy that covers everything, but it means let's do something to cover part of this. Again, Illinois Partnership qualified for this type of plan. It's a traditional plan. Then we move on to life insurance with living or accelerated benefit riders. It's different now. So this is life insurance with living benefits. Maybe you haven't heard that term before. Life insurance was always for those left behind. No, life insurance is for us too while we're alive. Might look something like this. Here's a life insurance plan with a built-in or optional rider that provides a monthly pool of dollars if we become chronically ill. The premium for this person, Michelle, age 50, was only $342. She gets a life insurance policy that starts out with an immediate $300,000 death benefit, naming the beneficiaries of her choice, but she gets to tap the money if she needs it now. She doesn't have to wait into the future. We put a 4% chronic illness rider on there, and when you take 3 times 4, it's $12,000. So what's cool about this is that while the other plans, most people can only afford, like starting out with $6,000, for this same premium, like in the 300s here, Michelle can have a 4% rider that equals $12,000 to start out with. Doesn't have to take it. Maybe she only needs 6,000 or 3,000, but she can take up to $12,000 per month if she becomes chronically ill. There's no waiting period, by the way, under certain circumstances here. A number of years ago, this particular carrier, and I'm not here to talk about brands today or market my firm. I'm here to educate you and help you. And if you want to do something and have a optional complimentary conversation, we welcome that, and you're more than welcome to do that. But this particular company, a number of years ago, changed their criteria that if you are disabled and not expected to be permanently disabled, there'll be no 90-day waiting period, and you can collect on this plan right away. And I want to take a step back. I kind of missed something. On the traditional long-term care plan, that is not a cash benefit. That is a reimbursement benefit, meaning that you need to use licensed facilities, licensed caregivers in order to get reimbursed. A piece of that, up to 25%, can be cash, meaning not cash under the table, illegal, but cash to pay an informal caregiver or a spouse or a partner or a neighbor to help you out. The kid next door, the college kid on break. This one, it's kind of a Swiss Army knife. It does it all. It's life insurance that pays your beneficiary in the event you pass. You can also tap it yourself and use the benefit if you need it for care, but if you don't, the $300,000 is still there. We're not talking about an investment discussion today, but there are plans where funds can be invested, and those numbers can grow even further, but I'm not demonstrating that here today. That's another talk. This one here, it's all cash. It's all cash, and it's from day one. No receipts required. Once you satisfy the 2 of 6 activities of daily living, the checks just start coming in. You do need to be dependent in 2 of 6 activities of daily living, but the benefits are cash, no receipts required. So that is a big plus with this. If you use, let's say the benefits 300,000 and you use 25,000 of it and pass away, the family gets what's left. Where the other plan, I don't want to call it a use it or lose it, but it's like homeowners or auto insurance. If you don't use the benefit, you don't get anything back. Here you get back what's left, maybe get all of it. If you never needed long-term care, the family is going to get the 300,000. And if it was an investment type of policy, it would be even a greater amount that we're not talking about today. An older existing life insurance policy. This I just finished this. This individual, age 64, Dr. Shane, had a $675,000 life insurance policy with a famous insurance company that did not have long-term care insurance rider back then, had no living benefits. He was paying $7,200 a year premium, and he had accumulated $689,000 of cash value in it. So this is a really, really, really good place to look for how can I fund a long-term care plan, and that is having a current plan that he exchanged for a new plan that, even though he's older, I was able to bring his premium down to 0. He had enough equity in the existing plan that paid off the $675,000 new plan with no further premiums required, and it's guaranteed to age 120. The one in the prior slide, the Michelle, that's guaranteed also. It will never change. It will never change that 300,000 where you'd be asked for more money, coverage taken away. Everything is guaranteed. The rider, the amount, the payment, everything. So here he got a new $675,000 plan, but lets him tap the money. So at death, his beneficiaries will receive a tax-free death benefit of $675,000, just like before. But here we put a 2% living benefits rider on here that gives him an initial tax-free benefit of $12,300 per month if he becomes chronically ill. The reason that we use the 2 instead of the 4 is that the first $12,300 is tied to some government regulations, and that's the piece that's tax-free. If you had a policy with a 4% rider, then we'd be talking $675 times 4%, and it would be a larger amount. And the $12,003 would be tax-free, and the amount over that would be taxable. So the 2 and the 4% rider are both available. These were both the same type of plans, but these people were very happy. His wife had none, and she took a new plan for herself. And because they weren't spending $7,200 now on his, they had money to spend on hers. So that was $600 a month, and they were able to use part of that to make a nice plan for the spouse. So all happiness here. This is a very nice option for someone that doesn't just want to pay and not get anything back. Then there's long-term care annuity funded plans. This is where you can use your IRA money, your 401k money, your 403b money, or a personal inherited IRA, and exchange funds out of there and get some money for covering the taxes, and have a plan that way. So this annuity funded plan for a single female, Mary, looked like this. She had an $88,241 partial IRA rollover that she put into this tax qualified long-term care annuity, which funded 10 years of a life insurance plan with a rider. And why did we have to go through these gymnastics? It's because that's the law. That's the Uncle Sam process, that it had to go into the annuity, come out of the annuity to pay the premium. But this is how we did it. So first of all, the first thing that happened was that she took that money out of the IRA, and it's taxable because it's been avoiding taxes all these years. So the plan, the company whose name we will not talk about at this time, gave her a 25% bonus. So the 25% bonus is manifested in the fact that the $11,030 would have been a smaller number without the 25%. So it came out with the bonus, the 25 gets added. So it was 88,000. She actually got $22,060 bonus put in her account, which spins off $11,030 for 10 years and pays for this plan. Now she had group insurance that was bought. I think it was this is group, so I could say the name. She had a Prudential group plan where she worked. They don't make them anymore. But her premium stayed the same for many, many years, and she had $5,000 monthly benefit, and she wanted us to supplement. She wanted more. So she was willing to do the 88,000. And with that, that's giving her a $74,000 death benefit, and it's giving her a lifetime benefit of $3,000 a month for the rest of her life. How long would 88,000 last if you needed long-term care and paid the taxes on it? Not very long, but she's going to get $3,000 a month to supplement her other plan for the rest of her life. And this made her happy. And we found a way to do it with the small amount. Not small, I don't mean 88,000 is small, but we found a way to give her the 3,000 and not have to disrupt too much of her retirement plan. Annuity funded life insurance plan for an unmarried couple. It looks something like this. Here we have Rick and Teresa. They took a $150,000 partial IRA rollover, put it into the annuity, just like in the prior slide, spins off $180,000 income base that came from $150,000 of their own money, but they got a $30,000 bonus. And that then spins off $18,000 a year for 10 years, gave them a life insurance plan with a $176,000 death benefit and $5,288 each lifetime long-term care benefit for life. So for them, that wasn't too painful. $150,000 long-term care would, if they needed it, it would be gone in no time. They'd have to pay the taxes on that $150,000, and it wouldn't last too long because we know the cost of care is pretty high. It can even cost more to be cared for at home when you've got someone 24/7 with you one-on-one. So for them, they have other assets, but that gave them $5,200 a month for life, and that worked out to be a nice solution for them. Then there's your life with long-term care asset-based hybrid, going into another plan. So this is an asset-based hybrid plan, might look something like this. And 60 years old, had a $100,000 CD coming due. This was a few years ago, wasn't making much. That today, today's dollars, $100,000 CD, a 3% return at age 88 would have grown up to $228,000 and been the interest on it been taxable. But with a hybrid long-term care plan, she put that $100,000 in this hybrid plan and had an immediate $375,000 pool of money. Nice leverage there, over 3 times. At age 88, she'll have 8 guaranteed, by the way. At age 88, $858,150, no tax on the growth. And if no long-term care benefit was used and she died, there was a death benefit in there of $115,000. So it's not a big money maker it's a smaller death benefit. You saw with the Michelle one, you saw the larger death benefit, you saw with the doctor, you saw the $675,000 death benefit. This is different. This is a hybrid. When you take lazy money, $100,000 sitting in a CD, sitting in your passbook account, reposition it over here, then have 3 or 4. And then if she were younger, if she were 50, she might have had $600,000 to start out with. And then that would be growing from there. So this is just another way to reposition dollars that are maybe sitting someplace not doing anything. So this is a hybrid. Then this is kind of new to talk about, is short-term recovery care plan. I have been able to, because I'm diligent at pre-screening people and have done this for a long time, nobody gets declined on my watch. I get the information ahead of time, no names, pre-screen. Like an attorney might present a case, I put through my presentation to the underwriters and I get people approved or find out the bad news ahead of time. So you don't put through an exam and the whole process and not know if you even have a chance. That's wrong. I don't do that. So a lot of work behind the scenes. Sometimes people pre-screen and they're not going to make it. But short-term recovery care is, and that one of those hybrids, the underwriting isn't quite as strict, but the short-term recovery care just has a handful of knockout questions. And if you're not walking with a cane and in a wheelchair and actively being treated for cancer and some other dread diseases, many people can get this plan that can't get anything else. So short-term recovery care plan looks something like this. Recovery care policy, it's got, you can actually have a home care rider by itself, but I'm showing you both here. So nursing home with assisted living coverage, 100-day waiting period, start out with a $9,000 a month benefit, and it pays for 51 weeks. Don't ask me why it's 51 weeks. It's got to do with it. If it's 52, then it has to comply with some other laws, so it has to be 51. So it's 51 weeks. That would cost $170 a month for Deb, age 72. If we put a home care rider on it with a 0-day waiting period, because I can customize these, I can pick the amount, the days, the waiting period, etc. Waiting period 0 days for home care. Gave her $1,200 a week for a maximum of 52 weeks. That adds $118 a month. She could actually buy that $118 a month thing by itself, standalone, or she could buy the nursing home one standalone, and that's a total of $288 a month. And that's it's not a lifetime benefit, but think of it as a recovery care. Think of it as needing help after a stroke or an accident or a heart attack or surgery not gone well. So this is just another alternative, and I can get people in here that we can't necessarily get into some of the other traditional plans. There's also one that's not demonstrated in my presentation here that doesn't underwrite for long-term care. They underwrite for life insurance. They underwrite for what's going to kill you, but not what's going to disable you. So if it's not going to kill you and they'll accept you on the life insurance side up to a table 4, which is the ratings based upon your health, there's a built-in free long-term care rider. The younger you are, the less it pays, but the older you are, the bigger the benefit is, where you get to use the bigger chunk of the death benefit. Thinking about this meaning, if you're 78, you're closer to your life expectancy than you are when you're 40. So therefore you get to use a bigger piece of the death benefit in cash for you to use now. So that's just another one that I actually was able to get someone in there that had a lifetime of MS since he was 25 years old. He had some incidents where he'd got some hits to the brain that are showing up on the MRIs, and was taking injections, and did have some occurrences, some relapses. And I got him a standard plan with this company and a long-term care rider, and no one his whole life had been able to insure him. I did this all behind the scenes, so we knew ahead of time that we had a strong green light, so there was no risk of being declined. And I'm going to mention that because years ago, if you had told me you were declined somewhere, I'm like, oh, it doesn't matter. A different company might have different underwriting guidelines, and that is still true. But the insurance companies now are saying, a handful of them, if you've been declined, we don't want you for a year, regardless of what you've been declined for, even if it's something that they would have taken. So I caution people to be very careful about letting somebody willy-nilly take an application from you, have you sign, submit an application. They don't know anything about your health. If they don't know what medications you're taking, what your medical history is, the surgeries that you've had, if they don't know that, then please don't go through with an application. But you want to be pre-screened first so that you've got a strong green light that you can go ahead, so that you don't end up with that decline. It's not like a ticket on your driving record. It's different, but it's like a bad mark on your credit. It's like having a bad mark on your credit report. Like, no, I got to fix that. And I do. I have to go and I have to overcome it. I have to, and like I said, it's kind of like an attorney presenting a case. I craft very thoughtful cover letters that go along with my cases, and have personal relationships that span many, many years. So it's just important to know what you're talking about when you're trying to help people that way. So how can we fund our plans? We talked a little bit about exchanging plans, but we could use investment money from CDs. We can exchange an annuity. There's lots of advantages for exchanging old annuities. People that have old annuities, it's a good thing. That should be talked about. If the surrender charge period is over and there's no penalties and it's not going to hurt you, there's many ways that you can help yourself. This is coming up, under age 59 and a half, $2,500 will be able to be taken out of 401ks, IRAs, penalty free if you're under 59 and a half from traditional retirement plans. And that was passed in 2022, and it will become a thing in 2025. Don't wait to 2025 if you want to do something, but just for younger people, they might want to know that. You can exchange an older life insurance policy for a new one and maybe even pay less, maybe even have it paid off and have living benefits on it, like we talked about. So existing cash value life insurance are very valuable if you don't have long-term care. Or it could just be your rainy day fund that you've been saving up for long-term care that hasn't maybe grown enough, or maybe some family gifting. If you've got a relative you're going to inherit some money, maybe talk to them ahead of time about doing some advanced planning. IRA, 401k assets, you saw slides where we repositioned some of the assets into a plan and got that 25% bonus. And then think about your RMDs. People are getting RMDs. Some of them don't even, many of our clients don't need their RMDs and end up just throwing them right back in the bank or reinvesting them. But it's a source of funds that maybe you're not using. The RMDs are coming out. You have to pay taxes on them anyway. So think about, maybe putting them in a long-term care plan. Okay. So questions. You must have lots of questions. Want this to be interactive?
All right.
Fire away with some questions. I bet some of those people on the Zoom call might have some questions, or perhaps in the room.
Yes, Miss Carol, we have some questions.
Okay.
So the first one is the guaranteed purchase option. Would it be cheaper than the compound inflation rider?
Guaranteed purchase option versus guaranteed inflation rider.
Correct.
Kind of apples and oranges type of thing. So maybe talk about that offline. We can narrow down the
Perfect
specific question on that, but happy to have a chat about it further.
Okay. The second one, I think you touched on it, but would you retouch on when qualifying for a long-term care policy, are pre-existing conditions counted against the coverage and or the cost of the policies.
You heard me mention with that one plan that has the free long-term care rider, that if you're rated up to a table 4 or under, life insurance and long-term care plans, some of them have rate classes. So they have preferred, super preferred, standard, and then some other areas. And that's a really great thing, because just because you're not standard, you don't get knocked out. So let's address the pre-existing first. Once you're approved on a plan, the pre-existing conditions don't matter anymore. Pre-existing conditions, if they occur and cause you to be disabled, aren't going to keep you from getting benefits. Pre-existing conditions could cause you to be able to not get insured, and that's why doing the pre-underwriting behind the scenes is important, to talk about those pre-existing conditions. Stuff like controlled blood pressure, the weight charts are quite liberal. I mean, they're very liberal these days. So even a past history of cancer can get through there. If you've had your knees already replaced, if you've got surgery pending, or if you're being actively treated for cancer right now, those things are red flags, and those things need to be postponed and maybe wait until we've recovered. So pre-existing conditions will not be excluded when we buy a plan. Pre-existing conditions are considered when we're buying a plan, and certified professional can talk you through that, take the data from you ahead of time, do the pre-screening, check with the companies. When I pre-screen, we're going out to all the companies all over the country that are writing these plans. This is done anonymously with your, age, sex, date of birth, and your medical history, and no names, so nobody knows about it. So have I answered that adequately?
Yeah, great job, Carol. Now I have a different one. Some employers offer long-term care insurance policies at some of the bigger organizations and companies. Wouldn't the group rate for those employees be cheaper than maybe an individual rate with the same benefit, or does it not work that way?
The group plans were very popular a while back. This one client that was on the slide had gotten up, Hartford was in the business, and a couple other companies. They're few and far between now, but we're seeing them come back. So my brother worked for the 39 years for the Department of Energy. They had a MetLife plan that he was able to pick up, a 5-year plan when he was working. His particular plan, he paid XYZ for it while he was working there, and it's been increasing every year since. However, this other lady that had the Hartford plan, hers has not been increasing. So without looking at it, without knowing the situation, there's not a whole lot of long-term care plans out there offered through the workplace. But definitely, if there's one out there, and if it's a reputable company, check on the history of the rate adjustments. Maybe doing it pre-tax. That's definitely a good idea to subsidize, or be the base of your foundation for your long-term care plans. Absolutely, people find it easier to have money taken out of their paychecks that they don't see. So it's definitely a good move. Can be a good move.
All right, Carol, that answers all the questions online. So the last thing that I want to mention is, for those of you who are here in person, Carol is going to answer some more of your questions here in person in just a little bit. But Carol has graciously put some packets of information together, and anybody that is viewing this can reach out, take a quick snapshot of the slide that's up on your computer, or you will hopefully receive this presentation via email shortly, within the week, and then you can reach out and she might be able to get you that additional packet of information. Carol, thank you so much for being here tonight.
Oh, you're welcome. Dina, we actually have takeaway folders, so they don't have to photo the slide. We've got takeaway folders with contact information on it. In front of you, you have your note-taking sheets, and if anything has inspired you under that immediate action item section, write it down, commit to what you want to do, for taking the next step. You're welcome to optional 30-minute phone consultation with me if you want to run anything by these calls.